"2022 was an extremely challenging year for markets, though we experienced a great rally in the fourth quarter across most asset classes. The S&P 500, which at one point in the year was down as much as 25%, actually climbed almost 8% in the last quarter to finish the year down only 18%. And small cap and international stocks returned around the same level. This was a historically down year for bonds, with the core bond index experiencing its worst annual return on record going back to the early 1970s. And bonds that were more sensitive to changes in interest rates were affected the most, as shown by the 30% decline in long-term government bonds. As a reminder, we typically stay away from investing in these types of bonds for this very reason. Credit risk, on the other hand, performed slightly better than interest rate risk this year, which is why high-yield bonds performed a little bit better on a relative basis. Now, I'd like to walk through 3 quick observations that we noticed in 2022. For the better part of the past 15 years, U.S. stocks have outperformed international stocks. Now, outperformance typically goes back and forth in cycles, and this has been a particularly long period of outperformance in one direction. In 2022, however, international stocks actually outperformed U.S. stocks. A lot of the losses that we saw this year are not actually from the international stock performance themselves, but rather the impact of investing through the US dollar, which we're accustomed to. When you exclude the impact of the US dollar and you focus instead on the returns gained in their local currencies, international stocks lost only 10% on the year, handedly beating the performance of US stocks by 8.5%. While it's natural for us to focus on an economy that we're familiar with and brand names that are familiar to us, it bears remembering that there's a lot of quality businesses that happen to be located outside the United States. We continue to think it's important and prudent to be able to still have exposure to those types of investments. The second observation was that it wasn't too long ago that all anyone could talk about in the markets was FANG, that basket of stocks including Facebook, Apple, Amazon, Netflix, and Google. These are some of the best businesses on earth and had historic runs in the stock market in the past several years. And it got to the point where many were wondering, why would you invest in anything else? Well, as you can see on this chart, 2022 was a bit of a different story, with that basket of stocks returning 43% for the year, which is a significant decline relative to the S&P 500's 18%. We think main messages that come from that. Number one, just because it's a quality business, and these continue to be great businesses, does not always mean that they're the best investment, especially depending on what kind of valuation you purchase the security at. And number two, diversification continues to be very important in any investment strategy. You may feel like you've split up your risk with 5 or so companies, but having exposure to all sorts of different sectors like energy and utilities and consumer staples can really help limit your downside when we experience periods of volatility like we have right now. Lastly, diversification across bonds and stocks didn't really have the outcome that we typically expect in investing in 2022. The traditional 60-40 portfolio had its 3rd worst year on record, which has led many in the media to wonder if the 60-40 is dead even. We think that over time, the benefits of diversification will continue to appear, and that this was more of an outlier than any kind of new normal. A big reason for why we think that this portfolio is going to do better in the future is that bond yields have risen dramatically since they did at the beginning of last year, and that should be able to buffer any kind of future volatility or headwinds that we may see in the future.